How much money do you really need to retire at 60? $1 million? 500,000? Maybe even less? You've probably heard all kinds of retirement numbers. Some people say you need $1 million. Others say 500,000 is enough. And some retirement calculators can make it sound like there is one perfect number for everyone. But here's the problem. There is no universal retirement number. The amount you need at 60 depends on something much more important than your account balance. It depends on how much you spend, how much reliable income you have, when you claim Social Security, how you handle healthcare costs, taxes, and how long your money may need to last. So today, we're going to answer the question in a different way. Instead of asking, how much money should a 60-year-old have? We're going to ask, how much money does your lifestyle actually require? And by the end of this video, you will have a much clearer framework for thinking about your own retirement number. This video is for general educational purposes only. It is not individualized financial, tax, Medicare, or investment advice. Let's start with the biggest mistake people make. Imagine two people. Both are 60 years old. Both have $750,000 saved. At first glance, they look equally prepared. But now, imagine that the first person expects to spend about $45,000 a year in retirement. The second expects to spend $80,000 a year. Same savings, completely different retirement situations. That's because your retirement number isn't determined by your savings alone. It is determined by the relationship between what you spend and what income you can count on. That income may come from Social Security, a pension, retirement accounts, other investments, part-time work, rental income, or other sources. So instead of asking, do I have enough money? Ask this. How much of my annual spending has to come from my portfolio? That question takes us to the next step. Before you calculate how much you need to know what you actually spend. This sounds obvious, but many people reach retirement without ever creating a realistic retirement budget. Start with the basics: housing, food, transportation, insurance, healthcare, utilities, taxes, travel, debt payments, home repairs, and the expenses you don't pay every month but know are going to happen eventually. A roof, a car replacement, major dental work, a family emergency, or something else you didn't expect. The goal isn't to predict every dollar perfectly. The goal is to create a realistic baseline. Let's use an example. Suppose your retirement lifestyle costs $60,000 a year. That's your starting point, not a recommendation, not a universal target, just an example. Now ask, how much of that $60,000 will come from reliable income? Because that number is far more important than the $60,000 itself. This is where retirement planning becomes much more useful. Let's say your annual retirement spending is $60,000, and suppose your expected Social Security benefit is $25,000 a year. You don't need your investment portfolio to produce the full $60,000. You need it to cover the difference. In this example, $60,000 in spending minus $25,000 of Social Security leaves a gap of $35,000 per year. That $35,000 is the amount your other retirement resources need to help cover. This is the basic idea behind retirement income planning, and your actual Social Security number can be very different from this example. The Social Security Administration says the estimated average monthly retirement benefit for a retired worker in January 2026 was $2,071. That works out to roughly $24,152 per year. But average is not the same as your personal benefit. Your benefit depends on your earnings record and the age at which you claim. So use your own Social Security estimate, not someone else's. SSA provides personalized estimates through your Social Security account. Now we get to one of the biggest retirement decisions. When should you claim Social Security? For people born in 1960 or later, full retirement age is 67. You can begin retirement benefits at 62. But SSA says claiming at 62 results in a benefit that is 70% of the full retirement benefit for a worker in this birth group. At age 67, the benefit reaches 100%. And if you wait until age 70, SSA's table shows the benefit reaches 124% of the full retirement benefit. Those percentages are important because the decision changes your income stream for the rest of your life. That does not mean 70 is automatically the best age, and it does not mean 62 is automatically a bad decision. Your health, family situation, employment, savings, taxes, and other sources of income matter. The important point is this: your retirement number can change depending on when you claim Social Security. Imagine your full retirement age benefit were $20,500 a month. Using SSA's percentages for someone born in 1960 or later, claiming at 62 would be about $1,150 a month, while waiting to 70 would be about $3,100 a month. Those are hypothetical calculations based on the SSA percentages, not a prediction of anyone's actual benefit. And this is exactly why your retirement calculation should consider Social Security timing. Let's go back to our example. Annual retirement spending, $60,000. Expected reliable income, $25,000. Portfolio gap, $35,000. Now comes a more advanced question. How large would your investment portfolio need to be to support that gap? There is no guaranteed answer. Investment returns vary. Inflation varies. Life expectancy varies. Taxes vary. And spending can change. But researchers use withdrawal rate assumptions to model retirement portfolios. For example, Morningstar's 2024 retirement research estimated a 3.7% starting withdrawal rate for a new retiree seeking a 90% probability of success over a 30-year horizon, under its specific assumptions about asset allocation and spending. This is a research estimate, not a guarantee, and not individualized advice. Using that 3.7% research assumption purely as an illustration, $35,000 divided by 0.037 is approximately $946,000. So a person with $60,000 of annual spending and $25,000 of reliable income might look at roughly $946,000 of investable assets under that particular illustration. Notice what happened. We didn't start with, you need $1 million. We started with your spending, then your reliable income, then the remaining gap. Only after that did we discuss the portfolio. That is a much more useful way to think about retirement. Number 6. See what happens at $500K, $750K, and $1 million. Now let's make this even easier. Imagine 3 different portfolio sizes: $500,000, $750,000, $1 million. Which one is enough? The answer depends on your annual spending and other income. Let's use the same 3.7% illustrative withdrawal assumption. A $500,000 portfolio would produce about $18,500 per year at that initial withdrawal rate. A $750,000 portfolio would produce about $27,150 per year. And a $1 million portfolio would produce about $37,000 per year. Again, these are mathematical illustrations based on a 3.7% rate. They are not guaranteed returns. They do not include taxes. They do not guarantee that the money will last. And the actual results depend on investment performance, portfolio allocation, inflation, spending patterns, and the period over which withdrawals occur. But the comparison is extremely useful because it shows something most people miss. A $500,000 portfolio may be very different from a $1 million portfolio, but the difference between them becomes much more meaningful when you know how much income your household actually needs. Now let's talk about one of the biggest retirement expenses: housing. A person who owns a home outright may have a very different retirement cash flow requirement from someone who still has a large mortgage or rents indefinitely. That's why I don't like statements such as, everyone needs $1 million to retire. A person with no mortgage, moderate spending, substantial Social Security, and a relatively simple lifestyle may need less than someone with a high mortgage, high travel spending, and expensive housing. Your retirement calculation should therefore ask, do I expect to have a mortgage? Will I rent? Will property taxes continue? What about insurance? What about maintenance? And what happens if the house needs a major repair? Housing isn't just an asset. It is also a cash flow decision. Healthcare is another reason retirement calculations can go wrong. Turning 65 generally marks Medicare eligibility. And Medicare is not the same as completely free healthcare. For 2026, Medicare lists the standard Part B premium at $202.90 per month. That's about $2,135 per year for one person before considering other Medicare-related costs or income-related adjustments. Medicare also lists a Part B deductible of $283 for 2026, and some people can pay more than the standard Part B premium, depending on income. So when you're calculating retirement expenses, healthcare needs its own line. Don't simply say, "I'll have Medicare." Ask, "What will I pay for premiums? What about prescription coverage? What about deductibles? What about dental and vision costs? What about expenses Medicare doesn't cover?" These costs can vary significantly from one person to another, but the key lesson is simple. Healthcare belongs inside your retirement number. Let's say you calculate that you need $60,000 a year. Is that $60,000 before taxes or after taxes? That distinction matters. Your retirement income can come from different sources, including traditional retirement accounts, Roth accounts, Social Security, pensions, and taxable investments. Those sources can have different tax consequences. Social Security itself may be taxable depending on your income and filing situation. So when you're 60, don't calculate only, "How much money do I need to live?" Also calculate, "How much gross income do I need to generate so that I have enough money after taxes?" The difference can be significant, and that's another reason a single retirement number cannot work for everyone. Number 10. Use 3 retirement scenarios. Here's a much better exercise. Instead of choosing one retirement number, create 3 scenarios. Scenario 1. Lean retirement, lower housing costs, moderate spending, limited travel, no major lifestyle upgrades. Scenario 2. Comfortable retirement, more room for travel, more flexibility, higher discretionary spending, more room for unexpected expenses. Scenario 3. High spending retirement, more travel, higher housing costs, more entertainment, higher discretionary spending. Now calculate the spending gap for each scenario. For example, purely as an illustration, lean retirement, $45,000 annual spending. Comfortable retirement, $60,000. Higher spending retirement, $80,000. Then subtract your expected reliable income from each. Now you have 3 different portfolio requirements. That is much more realistic than saying, "I need $1 million. Let's see how the numbers change. Suppose your annual spending is $50,000. And your reliable annual income is $25,000. Your gap is $25,000. Using the same illustrative 3.7% withdrawal rate, $25,000 divided by 0.037 is about $676,000. Now suppose your annual spending rises to $60,000. Your gap becomes $35,000. That produces an illustrative portfolio requirement of about $946,000. Now suppose you wanted to spend $70,000. The gap becomes $45,000. At 3.7%, that's roughly $1.22 million. Look at what just happened. The difference was not caused by some magical change in the stock market. It was caused by spending. This is why controlling your retirement expenses can be just as important as increasing your investment balance. Now let's address the question many people are secretly asking. What if you're 60 and you don't have enough? First, don't assume the answer is, "I missed my chance." You may still have several choices. You could work longer. You could increase savings. You could reduce future spending. You could change your retirement date. You could reconsider housing costs. You could delay Social Security, depending on your circumstances. You could combine part-time work with retirement. Or you could create a different retirement lifestyle. The IRS currently allows substantial retirement plan contributions for older workers. For 2026, the employee contribution limit for many 401k, 403b, and governmental 457 plans is $24,500. The standard catch-up contribution for eligible participants age 50 and older is generally $8,000. For eligible participants who turn 60, 61, 62, or 63 during 2026, the higher catch-up limit is $11,050. The IRA contribution limit for 2026 is $7,500, with a $100 catch-up contribution for people age 50 and older. These limits are subject to plan rules and eligibility requirements. So turning 60 does not automatically mean the saving phase is over. The bigger lesson. So, how much money do you really need to retire at 60? The most honest answer is, it depends. Not because retirement planning is impossible, but because retirement is personal. If your household spends $45,000 a year, you may need a very different portfolio from someone spending $80,000. If you have a pension, your retirement number changes. If your Social Security benefit is large, your portfolio requirement changes. If you have a mortgage, it changes. If you plan to travel extensively, it changes. If you retire earlier, your portfolio may need to support you longer. And if you delay Social Security, your future guaranteed income may be higher, but you need another source of income during the waiting period. There is no single magic number. There is a calculation. The simple retirement number formula. Here's the framework I want you to remember. Step 1. Calculate annual retirement spending. Step 2. Estimate reliable retirement income. Step 3. Subtract reliable income from annual spending. Step 4. Estimate how much of the remaining gap your portfolio may need to cover. Step 5. Stress test the plan for taxes, healthcare, inflation, housing, emergencies, and a longer retirement. And finally, create more than one scenario. Don't ask, "Can I retire with $500,000? Ask, "How long could $500,000 support my actual spending after accounting for Social Security and other income?" That's a much better question. Final takeaway. If you're 60 today, your most important number may not be the size of your retirement account. It may be the gap between what you spend and what reliable income you can count on. That gap is what your savings and investments have to help solve. And once you understand that gap, retirement planning becomes much less mysterious. You don't need a headline. You need a plan. You don't need someone else's retirement number. You need your own numbers, your spending, your income, your Social Security estimate, your healthcare costs, your taxes, your housing, and your timeline. Retirement isn't a single number. It's a system. And the sooner you understand that system, the more options you may have. If this video helped you understand retirement planning in a more practical way, subscribe for more evidence-based retirement and personal finance education for adults 50 and over. And tell us in the comments, what retirement number are you trying to reach? $500,000, $750,000, $1 million, or something completely different? We'll see you in the next video.